So we're all waiting, right? Waiting for the Federal Reserve to finally pop the champagne and declare victory over inflation. But what if the real danger isn't what we're looking for? What if it's not a big inflation comeback? And it's not a deep, painful recession either? What if it's something else entirely? Something hiding in plain sight?
If you listen to the news, it feels like the economy only has two settings right now. On one side, you have the all-out war to bring inflation down. And on the other, there's this constant fear that the medicine, all those interest rate hikes, is going to push us off a cliff into a recession. It really feels like we're being told to just pick our poison.
But what if that's a false choice? What if there's a third way this could all play out? A scenario that isn't about some sudden dramatic crisis, but more of a slow, grinding new normal that could quietly take over the US economy by 2026. Let's unpack what that actually looks like. So what is this mysterious third option? Well, it has a name. It's being called Stagflation Lite. And honestly, it might just be the most important economic concept to understand where we're all headed. Now, when you hear the word stagflation, I know what you're thinking. The 1970s, right? Brutal inflation, crazy high unemployment, a total economic disaster. But this is different. Stagflation Lite is kind of like its quieter, more persistent, and really annoying younger cousin. It's all about weak growth, inflation that just refuses to go back down to that 2% target, and a job market that gets softer but doesn't completely fall apart. Okay, so here are the three main ingredients for this lovely economic cocktail. First, you get sluggish economic growth, kind of stuck in the mud below 2%. Second, you've got that sticky inflation, just hovering stubbornly between 2.5% and 3.5%. And third, unemployment starts to creep up, just a little bit.
And that's exactly what makes it so sneaky. It doesn't feel like an emergency. There's no big stock market crash on the news. It's more of a slow, steady squeeze. It's that feeling where your paycheck doesn't quite stretch as far, your savings by a little less every year, and the whole economy just feels kind of blah.
So if this is such a real possibility, why isn't it the main story on the nightly news? Well, that brings us to the official story from the Federal Reserve, which, let's just say, paints a much, much prettier picture. And you can see the two competing visions right here. On the left, you've got the Fed's absolute dream scenario, the soft landing. Inflation is vanquished, growth is steady, jobs are plentiful, it's perfect. But then on the right, you have the stagflation light scenario. Inflation is still annoying, growth is weak, and jobs are getting a little scarcer. The contrast is, well, it's pretty stark. And this quote just hits the nail on the head. The Fed's outlook is incredibly optimistic, but more and more people are looking around at the real economy and saying, hang on a second, that's not what we're seeing. So what is the official forecast missing? Well, the folks who are worried about stagflation light point to four major blind spots in the Fed's sunny outlook. Four cracks in the foundation, if you will. First up, services inflation. I'm talking about things like your rent, your car insurance, your healthcare. These costs are notoriously sticky. They don't come down easily. Second, wages are still growing at around 4 to 5%. That's great for workers, but it's way too high to get inflation down to 2%. Third is demographics, and this is a big one. Our workforce is getting older, which means fewer workers and higher labor costs. The Fed can't print more people. And finally, there's fiscal policy. The government is still running trillion-dollar deficits, which pumps a ton of demand into the economy and basically works against everything the Fed is trying to do. Now, this isn't just some abstract theory for economists to argue about. There's actually a specific timeline that people are watching. All these pressures are building, and they seem to be heading for a collision course right around the year 2026. By 2026, the theory goes, these three big trends are all going to converge. You'll have slower growth because people will have spent their pandemic savings and businesses will be more cautious. You'll still have stubborn inflation coming from essentials like housing and energy. And you'll see unemployment tick up to maybe 4.5% or 5%, just enough to make things feel sluggish, but not enough to actually crush inflation. And that trifecta, well, that is the textbook definition of stagflation light. Okay, enough with the high-level economics. What does all of this actually mean for you? For your money, for your investments, for your financial plans? Because this isn't just an academic debate. It has very real consequences. In a stagflation light world, the investment playbook kind of gets turned on its head. Stocks would probably face some serious headwinds because of that slower growth. But things like commodities and gold, which are classic hedges against inflation, they could do pretty well. And maybe most important, this scenario suggests that those long-term interest rates would stay higher for longer than anyone expects.
That could mean it's a better environment for things like value stocks and energy companies.
I know, this all sounds a little bleak. So it raises the obvious question. Are we trapped in this cycle? Is there any kind of escape hatch?
And here is the fundamental problem. The Fed really only has one main tool: interest rates. They can raise them or they can lower them. But that tool is designed to manage the ups and downs of the business cycle. It's not designed to fix deep structural problems like an aging population, a massive housing shortage, or huge government deficits.
The real solutions are, well, they're a lot harder. They would require huge policy changes, like figuring out how to expand the labor force, finding ways to build a lot more houses, and of course, getting government spending under control. These are not things the Fed can do with the flip of a switch. These are massive political challenges.
So as we look ahead, maybe the big story isn't going to be a dramatic crash or a triumphant victory. Maybe the real story is the economy just drifting into this new, subtle, and quietly dangerous reality. Not a crisis, not a recession, but stagflation light. And the question that leaves all of us with is, are we and are our portfolios really prepared for a long, slow squeeze?